Thank you all for joining us here today on the panel, Risk and Rewards and Outlook for CBDCs, Stablecoins, and Settlement Coins. I'm Irene Liu, and I'm the Chief Governance and Reporting Officer of Union Digital, a digital bank in the Philippines looking to issue Philippines Peso Union Digital stablecoin. Now, prior to Union Digital, I was the Risk and Regulatory Consulting Lead Partner of a Big Four firm. I will be your moderator for today. Now, the background to this conversation is that cash will no longer be king. Ever since Satoshi Nakamoto issued a white paper on Bitcoin in 2008, technology has evolved by leaps and bounds over the last decade. Currencies are highly volatile. Cryptocurrencies are highly volatile and do not provide the same investor protection against abuses and fraud. So enter stablecoins. They have the similar benefit of providing faster and more efficient retail payments, especially in the cross-border context, but with the added benefit of having a relatively stable value. Now, the emergence of stable coins will continue to challenge the effectiveness of the existing regulatory and supervisory approaches, as has been discussed throughout the panels this morning. So CBDCs, meanwhile, will likely yield impacts of financial and monetary systems that will go far beyond the current imagination. In this panel, we are joined by some very experienced and distinguished speakers to discuss the challenges and opportunities of adopting CBDCs, stablecoins, and settlement tokens. So let me introduce to you the panelists. First of all, we have Rocky Mui, who is a partner of Clifford, a funds and investment management firm in Hong Kong. Rocky covers the Hong Kong fintech practice, specializing in virtual assets, blockchain, and in fact was involved in CBDC initiatives in Singapore and Hong Kong as well. Next, we have John Ho, Global Head of Legal Financial Markets for Stanchart, overseeing and providing legal advisory, transactional, and documentation support for the financial markets. He's also the co-chair of ISDA Southeast Asia Legal and Regulatory Committee. Thank you for joining us, John. Next on the line, we have Douglas Arner, who is the Kerry Holdings Professor, University of Hong Kong, and a renowned thought leader on financial regulation, particularly the intersection between law, finance, and technology. Last but not least, we have Charles Dorsey, Asia Managing Director and Head of FinTech of ConsenSys, a blockchain technology solutions firm. He has been heavily involved in CBDC projects across multiple countries, including Australia, Thailand, Singapore, Korea, and many more. Prior to ConsenSys, Charles was the head of FinTech with the Hong Kong government. So let me start off the discussion panel properly. So to set the scene, I would like to invite John to discuss some of the key drivers for the rising popularity of CBDCs and stablecoins. John, please.
Thank you, Irene. I think what's driving the sort of interest in CBDCs are a number of themes here. First is the pandemic. So ever since the pandemic have occurred 2 years ago, there's been an acceleration in the adoption of contactless and digital payments, and the use of cash have declined in a number of countries given the restrictions and given the inability to continue to transact in sort of using banknotes and coins. The other themes that is also driving this is the digitalization in payments. There's now in a lot of innovations in payment in terms of improvement and modernization of payment rails. At the same time, also an adoption of privately issued digital tokens. And also the other thing that's driving that is the rise of stablecoins especially in the decentralized and crypto world. Last but not least also is the decentralized finance, which is what we call DeFi, which is have grown exponentially, which is right now grown to hundreds of billions of dollars in terms of assets locked in value. These have driven the central bank to sort of have a wake-up moment to say, you know what, we better make sure that we have a digital central bank digital currencies in a digital form to provide a viable alternative, which is the anchor of payments and also public money that parties can use. Because at the end of the day, the alternative modes of payment are not public money. They don't form a liability on a bank's balance sheet. I think it's important to note that the rise of obviously the likes of Facebook who wanted to issue the stable coins have also given an added impetus for central banks to get together to look at a digital option of central bank money in a form of CBDC.
Thank you so much, John. In fact, I like it now how you have in one, little bit of a nutshell, pull in multiple, items on stable coins and CBDCs. So maybe before we start, right, so I want to also, maybe focus on CBDCs before we touch on stable coins. So I'd like to invite Rocky, right? We know that actually, in the recent, in fact, just a week ago, the Global Markets Financial Association, BCG, and Clifford recently released a paper on the benefits and challenges on wholesale CBDCs. Now, beyond just CBDCs, now we have talked about, wholesale CBDCs and retail CBDCs. So Rocky, can you just help us to draw the distinction between what's a wholesale CBDC and what's a retail CBDC?
Yeah, thanks, Irene. I mean, it's quite an interesting concept in terms of CBDC and what we're talking about, because as a user, I think what we talk about is we do want to see CBDC at the retail level, so we can actually use the money. So basically, your notes and coins reflected in a digital format, and then you can spend it. It's quite a similar concept to kind of the existing kind of store value facility items, etc. But the key legal difference, it is in its own right a form of legal tender itself. So that's kind of the retail level where people can accept payments and you can use it and spend it, etc. Now at the wholesale level, it's really something between the central banks and all the participating banks in the core financial system. So something behind the scene where retail will not be able to see. It's more at the kind of the wholesale level, how the government, central banks can manage their monetary policy, having the supply of actual money in the financial systems, and at the wholesale level, the government's kind of core concept is to make the whole process a lot more efficient, whether it's for settlement, monitoring, and kind of all the data flow, etc. So that's kind of the key difference between kind of what we talk about the wholesale and the retail level.
Thank you so much. That's so insightful. So, but when Satoshi wrote the Bitcoin paper in 2008, the vision was to actually achieve a seamless, borderless payment system. Now today, there are multiple efforts across jurisdictions to build, faster payment systems domestically, as well as also regional and global initiatives that are expected to achieve near instant cross-border payments. Now, with this in mind, I'd like to ask Charles, right? Are there still benefits to CBDCs, to central banks issuing a CBDC beyond just cross-border payments? And if you think so, what are the benefits involved?
That's a great question, Irene. Thank you for that. I think what is really coming to mind for these central banks is really looking at how they can upgrade the infrastructure for their financial ecosystem. If you look at the back end of banks today or capital markets, there is still quite a few computers which are soon 20 years old or so. The SWIFT system is also calling for an upgrade. So there is I think a will from many central banks to make sure that to remain competitive as a financial industry, you want to update and upgrade the software their financial institutions are running on. So I think there is really one aspect here of upgrading to remain competitive in the global financial landscape. Then there is also an opportunity for central banks issuing CBDCs to support their banks and financial institutions which are regulated in applying and managing the regulations which are growing. A lot of the regulations around KYC, AML, and many others are essentially an heavy burden for banks and FIs. And by upgrading the software of the financial system via CBDCs, there is many options for central banks to lower the cost and the burden of these regulations. And it's an opportunity to keep markets being healthy and efficient, but also by providing new tools to the banks, and that's very important. One thing which triggered a lot of activity on the CBDC front was when Facebook at the time launched a project called Libra, and I think it was one of the catalysts to really accelerate a lot of the research and explorations from the central banks on CBDCs, and making sure that their domestic currencies remain relevant and not having the risk of people starting to trust more a currency issued by or an asset issued by a social network, for example, and leaving behind the domestic currency. And if you think about it, it's something which is possible and which could be a very big risk from a systemic point of view. So CBDCs are definitely very important for central banks and ecosystems in general. And maybe the last aspect is in terms of keep building on the concept of upgrading the financial system for FIs, is thinking how we can design a new type of finance, which we call a composable finance, which means that instead of having kind of silos and products which are sitting in their own universe and gardens, starting to see how you can essentially connect and build financial products in a healthy manner, which compose on each other's. Should you be having a loan, for example, and building some other product around it. So I think the big concept and the opportunities for central banks are upgrading the financial system, lowering the burden for banks on regulations and various guidance, as well as discovering a new generation of finance, which we call composable finance.
Thank you so much for the explanation. So, and we know, right? So now, given that Charles has actually explained the importance of these CBDCs to the central banks. So what we've observed is also the central banks globally are contemplating the risks and benefits of issuing the CBDCs as well. So they are taking, quite a deliberated approach to consulting the public on the consultation papers. So, and of course, the design elements and the legal implications are also deliberated at the same time. So amongst the major nations, China has been the most advanced around the CBDC, the e-renminbi issuance. So Douglas, I know this is home ground for you. So can you please share the latest developments on China's CBDC?
Thanks for that, Irene. And I think China provides a great example of the points that Charles, Rocky, and John were making about rationales. And I think really the key point when we're thinking about CBDCs is that you start with the circumstances of the individual country, the individual jurisdiction, and then you think about the technology. And I think it's ironic in some ways. You mentioned Satoshi, you mentioned Bitcoin. The idea at the very beginning of that idea was a challenge to sovereign-based currencies. And of course, what we have with CBDCs in some ways is the classic idea of the empire strikes back, taking that technology and responding to that challenge to try to build, in some cases like China, their exclusive alternative to eliminate any possible competitors. Now, if we look at central banks everywhere in the world have a great deal of engagement with payment systems. The area of technology that central banks know better than anyone else is really on the payment side. We've seen Fedwire, Telegraph, SWIFT, RTGS systems, FPS, CBDCs are an evolution of a long-term process. And if we look at China, China began experimenting, the central bank experimenting with blockchain 2013, 2014, looking to see whether this new technology might be usable. And I think most central banks had come to the conclusion by around 2016, 2017, that it was interesting, but they weren't going there yet. And 2019, as Charles mentioned, Facebook's announcement of Libra accelerates the project. And we see in Hong Kong the announcement by the People's Bank of China just a couple of months after of the intention to launch what was then called DCEP, the Digital Currency Electronic Payment System, now generally known as the ECNY. Well, why? Well, one reason, of course, is a response to the potential threat of a foreign private alternative. That's one. But the second was also a recognition that the emergence of the duopoly of Alipay and WeChat Pay was posing both risks from the standpoint of cybersecurity and financial stability, but also from the standpoint of potentially constraining development because of their lack of interoperability in the context of payments. And so one can see this as a means to build an electronic backup, to build a system to ensure interoperability, to support greater competition and innovation in the financial system and in the economy more broadly. One can think of it from the standpoint of building a monetary instrument which can be embedded in blockchain applications instead of other alternatives, which we'll be talking about later, and that giving a strategic boost to China's ambitions in the blockchain area. And of course, finally, financial inclusion. And yes, we can often talk about the billion people in China that use Alipay or WeChat Pay, the 300 million downloads of the eCNY app, but that still leaves 200-300 million people that don't have access to modern electronic payment systems. And certainly one of the functions, one of the objectives was to bring them in. A second, and something that anyone who has been to China in the past 5 years will recognize, is as a foreigner, the challenge of really doing anything in a big city without access to electronic payments. And so the Beijing Winter Olympics was meant to be a national rollout where you could roll this system out, where all of the millions of foreign visitors coming in could use it all across the country so that they could better engage with the economy. Now, of course, that plan as a result of COVID has not happened. But what we are seeing this year is the national pilot of the system. We'll probably see some evaluation, which will then lead to a full rollout. My guess is next year.
Thank you so much, Douglas. I think that was a very good background context to the issuance of the eCNY. So now I'm also keen, right, to move across to other jurisdictions as well. So how soon are we likely to see a CBDC from another major nation? So I'd like to invite Charles, given your work with, central banks, could you share with us the progress in the other Apec markets, that they are making in this space?
Sure, absolutely. ConsenSys has a chance to be involved with many central banks on various CBDC projects over the years. If you look at 2021, 2020, you've seen a really interesting project at the Reserve Bank of Australia on using CBDCs for settlement of syndicated loans. Of course, ZMAS has been engaging with the UBIN project in many different phases, looking at how the wholesale CBDCs can be used cross borders, and for many other use cases. There was a hackathon a few months ago organized by ZMAS, where you've seen many technologists and banks kind of highlighting their achievement. Going a little bit up north. In Thailand, you've seen a program focusing on CBDC for retail users, where ConsenSys was involved as well, looking at really how you can scale these networks to reach the right throughput of transactions, the number of transactions per second on those networks. One project here in Hong Kong involving multiple jurisdictions has been the M-Bridge, where we had the chance also to be involved as technology partner for the project with the BIS, SDHKMA, CBUAE from Dubai, as well as the Digital Currency Institute from the PBOC. And Bank of Thailand. So it's really impressive to see how central banks have been over the years, I will say, working on their own for their domestic market type of use cases. And now we start to see more and more central banks kind of joining programs together, where you see the number of central banks kind of teaming up, growing, and it gives really a good signal that this infrastructure is really going into being a global CBDC infrastructure, where the currencies will be really fluid between different jurisdictions and multiplying the use cases. So a lot of use case, a lot of activity. We've seen also the central banks of Korea deploying a very large double-digit budget on CBDC experimentation. So it's definitely gaining momentum. And maybe on the edge of CBDCs, and I'm sure we're going to touch on this later on, we start to see also more research and more projects and green lights around stablecoins, which are an adjacent new generation of money as well.
Thank you so much. Now, I hear a lot of interesting developments in Apec, right? And I'm pretty sure, there has been some of these similar developments, if not more, in the other countries such as the US, EU, and UK. So I'd like to invite John. Given your role as a global legal head in StanChart, what are your perspectives on the developments of the grounds in these jurisdictions?
Thank you, Irene. I think first off, in terms of the Bank of England, the reason why they're looking at the CBDC is in response to the payment trends. As I mentioned earlier, they want to make sure that public are given access to central bank money in a digital form. And second point is to guard against the risks of private forms of money. Third is to enable competition and innovation in this area. So the CBDC that currently is under exploration by the Bank of England is looking at more the retail CBDCs. And what would be the form of CBDC look like? So they envisage currently, from a sort of a high-level perspective, a platform model where CBDC is issued via centralized sort of ledger basis. And I think the discussion is there are now two committees being formed to explore the CBDC. The first would be the CBDC Engagement Forum. The second is to look at the CBDC Technology Forum. So the engagement forum is to gather input from senior stakeholders across the industry, academia, civil society, to look at the practical challenges in terms of designing, implementing, and operating a CBDC. The CBDC Technology Forum is to gather input on the technological design from the sort of technical expertise. The kind of things they are looking at or thinking right now can be bucketed into three key areas. First, what are the economic implications and design choices surrounding CBDC? Should CBDC be interest-bearing? Who should access CBDC directly? Or should there be a limit on CBDC holdings in transactions? The second aspect would be the functional design. What types of payments functionality is required? How might users interact with, initiate and accept payments? How best to ensure financial inclusion? What is the role of a digital ID? Because in order for CBDC to be successful in a frictionless manner, one of the sort of other ancillaries, a key driver, is to have a digital identity in digital form. Last but not least, the key consideration and the Bank of England CBDC is around technology. What is the right architecture for a CBDC system? How might one deliver the necessary performance from a security perspective, operational resilience? For a CBDC, there is a wide scale to be adopted. So moving on from the Bank of England, I'd like to touch on what the ECB is doing. So ECB is now on a 2-year exploratory, or what we call investigative phase, to explore whether a digital euro ought or should be issued from a policy perspective. So they are in that journey. They obviously have formed a digital euro working group as well. And on a timely basis, Fabio Panetta, which is a executive member of the board of ECB, just a couple of days ago, given an update on where the ECB status would be. A couple of highlights to share with the forum here is the ECB is now considering how to make digital euro a convenient medium of exchange, but not as a form of investment. So, i.e., they still look at it as a medium of exchange, a store of value, but not for speculative purposes. They are also considering the pros and cons of introducing what we call a quantitative cap on digital euro holdings, or what we call a tiered remuneration that would disincentivize excessive holdings. It's also analyzing what the impact of a digital euro will look like from a monetary policy perspective. And also they're going to consider whether digital euro should be made available within private payment solutions, because as you know, in Europe, there's a lot of what we call PSD2 have allowed for a lot of neobank, challenger banks, and payment services to flourish. They just want to make sure that how would these service provider play a role in circulation, distribution of digital euro. More importantly also is the consideration of ensuring how a digital euro could foster digital financial inclusion. The other point to think about is the disintermediation risk. If CBDC is issued, what is the impact towards the financial services? Would it crowd out deposits and make bank funding more expensive? These are what we call unintended consequences that have to be considered as well. Now, moving on to the US, in the United States, just about a couple of weeks ago, the Federal Reserve have published 2 reports. One is on a policy perspective in terms of kind of key considerations, or on an exploratory perspective, what are the sort of key factors, pros and cons, in terms of issuing a digital dollar. The other paper is on a technical paper. If a CBDC, if a digital euro were to be issued, a digital dollar were to be issued, from a technological stack perspective, what the architecture will look like. In the US, the Fed has also tied up with MIT on a test environment to test the technological architecture in it. But I think it's important to bear in mind, in most of the 3 jurisdictions, the central banks have been quite clear that at this point, they haven't reached an inflection point to issue a sort of CBDC. But I think the current research investigative phase will inform policymakers and governments to reach that decision in the next 1 or 2 years.
Thank you so much, John. I feel like I've taken a trip around the world, following your developments. And also thank you so much, right, for sharing with us the design considerations as well, when we are looking at designing a CBDC. So maybe I want to change gear a little to look at the coexistence of CBDCs and stable coins. And we know, right, the stable coins have actually, grown in volume in the last 2 years exponentially, from 5.6 billion just in the beginning of 2019 through to about 157 billion at the end of 2021. So, and with of course some of these risks and concerns by regulators on the stable coins and the risks that they pose. So, can actually stable coins coexist with CBDCs? Is there really a future for stable coins? And so I'd like to pose this provocative question to Rocky and to John. Maybe I'll invite Rocky first.
Yeah, thanks, Irene. I think that's a very good point. I mean, it's people are thinking about it as well. But for me, I think definitely they can coexist, and there is definitely a future for stable coins. Now, looking at CBDCs and stable coins, I do see them serve different purposes. So they're different creatures doing different things. You have CBDCs, which is kind of the core, kind of going to call fundamental financial structure of a particular economy. It could be wholesale, it could be retail. And for stablecoin, it's really more focused on the commercial usage. It could be for general payment purposes at retail. It's not as popular right now, so we don't see it being used like day-to-day getting a coffee at your local coffee shop, but it could go that direction. And right now it's more we see it's to meet the strong demand on the virtual asset side. So it's a very efficient bridge connecting with virtual assets. And linking it back to the existing financial framework, in particular how to link it back to fiat currencies, whether it's for valuation purposes or for settlement or the actual exchange with fiat ultimately. So all in all, there is a bright future for stablecoins.
Thank you so much. What about John? What are your views on this?
Yeah, I think it's important to bear in mind when we talk about stable coins, it's not one type of stable coins. As you know, there are actually 3 or 4 sort of categories of stable coins. One is obviously fiat bank or fiat peg stable coins as we know it, with Tether, USDC, and obviously what used to be Libra coin or DM coin that was in the sort of works. And then you have algorithmic coins. They're coins that are using algos to drive the supply and demand for stable coins. And the other third category is your asset-backed sort of stable coins that are backed by real-life assets, whether it's gold or other sort of assets of value, or even crypto assets, which is the 4th category as well. So I think the key point is, if stable coins are linked to more the fiat type or the fiat-backed stablecoins, this is where the area of focus would be for the regulators, because it poses potentially, and what now they claim is obviously a systemic risk, because if you look at the market cap of stablecoins, 2 years ago was less than 5.7 billion. Fast forward now, depending on what you're looking at, as of the 5th of Feb, the FSB has reported that the market cap has reached 174 billion. It might have come down given the recent volatility, but the headline item is these have grown exponentially, right? So the key point here is, to your point, can they coexist? If you look at the payment type, what the regulators look like is they will only allow you to coexist in the future where they're subject to, if you're going to behave like a payment type financial services, you're probably going to be subject to the same level playing field, same activity, same risk, same regulations. But in respect of institutional stablecoins, like a JP Morgan coin, which is essentially more like a tokenized deposit rather than a true stablecoin, that has a use case because it's meant for internal transfer, liquidity management within an ecosystem that is well contained. I think that part would be less of a focus for policymakers. I think where their concern is the mischief that some of the stable coins may give rise to. For example, as I talk about the fiat-backed, where it is of a global stable coin nature, it may give rise to financial stability risks, consumer protection and investor protection. Last but not least, also prudential risk has been highlighted by the Federal Reserve Board, where currently there are regulatory gaps in looking at this. And this is why the FSB, the BIS, and a number of central banks are getting together to look at what regulatory gaps that need to address if they were to allow a global stable coin to flourish on a cross-border nature.
Thank you so much, both. So, and I think, just now, John actually alluded to the FSB report, which is the FSB Cryptocurrencies Vulnerabilities Assessment Report that was just fresh out of the oven and issued last week. So, and in the report, right, it stated that, cryptocurrencies markets are fast evolving and could reach a point where they represent a threat to the global financial stability due to their scale, their structural vulnerabilities, and also increasing interconnectedness with the traditional financial system. So in this report itself, they highlighted concerns about the possible disruptive runs on their reserves, amongst other risks, which could create knock-on effects to short-term funding markets. Now, for this, I'd like to invite John to share with us your thoughts on this paper. What should policymakers consider in terms of regulations, and who are the ones that the regulators should seek to protect? John, please.
Yeah, sure. I think the first thing that people bear in mind is who are the target, or how the target audience you want to protect. Is it retail, man in the street, or you're looking at a savvy institutional investors? But I think in a lot of the central bank or BIS or FSB paper, the focus is on the man in the street, the retail, partly because when we look at these types of innovation, whether it's stable coins or digital currencies, or now decentralized finance or other types of acronym, some of them are pretty complex. For the man in the street, beyond looking at high yield, because if you look at some of the stable coins, that Tether or others, you can get more than 12% if you keep it within the stable coin on an annualized basis. But people don't realize that there is no such thing as a free lunch, right? If you're going to stake your stable coins with a crypto exchanges or on a DeFi platform, there are certain risks, because what they do is they take stable coins, they on lend or they do financial services with it on a leverage basis. So I think the key point here is we need to look at, if you're looking at retail investors, this is where policymakers are very focused. In recent times, there's been a raft of circulars, warnings to retail, whether it's Singapore, Hong Kong, Europe, UK, to warn investors that do not equate investment in stable coins or crypto assets as similar to bank deposit. Because as I mentioned earlier, unless it's a CBDC, which is a direct CBDC that forms a direct claim on a bank balance sheet, privately issued stable coins are not the same as public money. In fact, you probably will be exposed to credit exposure. So I think the point here is in a context of retail, the educational level, the promotion and restrictions that currently being made applicable should or you remain, but at the same time, I think it's important for retail, if they were to invest, is to make sure to distinguish between professional investors and retail investors. So I think that educational and distinction is key.
Thank you so much, John. Now, Douglas, I want to tap into your experience, both in the regulatory space and also in the academic space, right? In terms of, so what should actually be regulated? Is it the technology or is it activity? And how should the regulatory mechanism work? Because we did mention that, the regulators, right, will need to draw a very fine balance between, suppressing innovation and versus, tightening the regulations around it to protect the public. So what is your thought on this?
Yeah, it's something that I think the last, we're looking at it's beginning of 2022. This is over a decade, almost 15 years now, since that we've been talking about these aspects of dealing with the balance between regulation and innovation. And I think it's been a really interesting evolution. If we think about the first few years, we had a number of central banks, a number of banking regulators that took very restrictive approaches to crypto digital assets. We then see an early focus on sort of criminal use, dark web, et cetera, and a focus there. But we continue to see, in many cases, for an extended period of time across the last decade, many regulators actually kind of giving some distance and letting things develop. Even we see the ICO bubble around 2018. In major jurisdictions, we see some actions, but still staying quite back. And I think it's interesting that I think two things really triggered a shift from kind of focusing on the market integrity AML side to something different. And the first was really Libra. If we think about the FSB's global regulatory efforts, one has been with the FATF in the context of AML, and this is something that we've talked about a lot. The second was really triggered by Libra, and we see this global process to build a regulatory system for global stablecoins. Now, the reality is so far nothing like what was envisaged, a sort of global stablecoin, a cryptocurrency issued by a global private tech giant. Nothing like that exists so far. And part of the reason is because there was a very heavy global regulatory response. And now we have a system whereby essentially most regulators in G20 Financial Stability Board jurisdictions have built or are building a regulatory system to address global stablecoins. But the challenge is there aren't actually many of those out there. But what has happened over the past couple of years is that the volume of other digital assets, including stablecoins, has grown pretty dramatically. And I think stablecoins are interesting because, of course, we go back to that original idea of crypto as an alternative to government bank financial systems. We can see the CBDC as a response, but the stablecoin is actually something that market participants have wanted to be able to link crypto and digital assets to fiat currencies and the traditional monetary system. And so they've evolved essentially out of the demand side. Now, so long as they weren't actually that big, regulators actually have kind of stayed back. But size-wise, scale-wise, and I think we really saw this in 2021. Markets broadened very dramatically all across the world in the context of users and levels of sophistication and size and volatility. And I think that has triggered this high-level focus at the global regulatory end with this FSB paper, which highlights from the standpoint of regulators all over the world, they are looking for ways to rein things in, but without causing a collapse of the market, because if you cause a collapse of the market, you actually trigger the damage that you're trying to avoid. So it's an escalation of regulation, but trying to balance without crushing the market. And I think when we begin to think about what regulators should do, One aspect is very much around the question of what are you talking about? Is this a direct challenger to the monetary system, as a Libra might be, or as an eventual global stablecoin, potentially a global stablecoin that is what we would call a synthetic CBDC, which has direct access to the balance sheet, the liquidity of a major central bank? And we can see discussions both in the context of China and the United States about this sort of model. This is something that would be a direct challenge to domestic currencies. The second is from the standpoint of payment systems. Is it really a sort of monetary instrument, in which case you want it to be treated largely as other sort of payment instruments? But the final one is a lot of stable coins are actually investments. In other words, the stablecoin issuer says that it is linked to a pool of assets, and the question is it really one-to-one backed with safe assets, or is there some amount of float going on? And the bigger the float, the more risk. And that's where our real concerns need to be, is things that are actually trying to say that they are stable monetary instruments, when in reality, they are leveraged investment products. And that, I think, from the standpoint of regulators, is why we are seeing this tendency to what I would call, to wrap up, a proportional graduated approach, which basically says you start with a functional activities-based approach. The smaller it is, the more you let it go. The bigger it gets, the more you need to pay attention. And at a certain level, when it's big, you move from an activities-based approach to an entity-based approach, where you regulate the large institution, product, infrastructure itself. That is the direction where I think we are going and where regulators need to be going. But it's not easy to do.
I love your idea of a proportional graduated approach to regulations. Now, I also know that recently, right, HKMA did issue a paper setting out its thinking on the regulatory approach for stable coins. So maybe I'd like to invite Rocky, right, given that you're in Hong Kong, to tell us a little bit about
in terms of the regulatory approach. So it's citing that it will remain agile. The framework will be risk-based and proportionate, which is a key point that I mentioned earlier. Now, it's again, the concept is to give priority to high-risk areas while allowing room for financial innovation. So that is very much appreciated by the MA. So the discussion paper, it's relatively open. It gives some thoughts on what the MA is looking to regulate, and it's very good to see they are trying to actively engage with the industry to work through the scope of the regulations, because as you can see, there are lots of, as John mentioned, there are lots of different types of stable coins out there. Which one should they be regulated and how do they do it? It's a big area. There are some interesting thoughts in terms of, other than kind of this type of stable coins, what type of activities should be regulated? Should it be kind of the primary activities, just the issuance, the minting, management reserve, etc., or also all the secondary activities, the brokerage, the exchanges, custodian, or whether it's the user or the merchants? What would be the trigger for license? What are the Hong Kong nexus required? Is it extraterritorial, eligibility requirements, etc., etc.? So there's a long list of actual detail that needs to be worked through. And the industry, we've been talking to quite a few kind of industry associations and also kind of market players. It's overall receptive and welcomed by the participants. But it is the detail that matters. And it's linked back to kind of the earlier items I mentioned before, which could have very different implication for different market participants. And obviously it's a very important topic. So I'll see, other than in Hong Kong, it's probably a general theme that other regulators will look to engage a more substantive discussion of the industry on a more global basis.
Thank you so much, Rocky, for that insight. Now, the last question I thought I want to pose, right, is we have talked so much about CBDCs and stable coins, but we've also heard about settlement coins. So I'd like to invite Charles, right, to just share with us, right, a bit about how settlement coins are different and how should they be regulated, and how they fit actually into the whole ecosystem.
Absolutely. It looks like the taxonomy we have started about new forms of money is never ending. After CBDC, stablecoins, now settlement coin are coming up. What are settlement coin? It's a trend which has been around us in different ways. Think of a gift card, and think of a gift card which you buy and you offer to someone, and you can spend within a shop or within a group of shops, for example. So settlement coin are something we start seeing in sometimes in finance, sometimes in communities in general on the internet. And it's not claiming to be a currency, but it's eventually a payment, a way of paying for services or goods within a closed ecosystem. To a certain extent, the JP Morgan coin, which has been evolving for quite some years now, is some kind of settlement coin. It does not claim to be backed by specific currencies or to be a currency itself, but more as a utility to essentially pay for services. So when we see this kind of ecosystems, should they be social media, social platforms, or financial ecosystems growing, there is some experimentation happening right now where people are looking at how they can essentially keep value within this ecosystem via the settlement coin. So another topic for everyone to explore and for regulator to frame, so everyone stays on the right direction.
Thank you so much, Charles. In fact, yeah, indeed, I agree, right? You know, settlement coins, global stablecoin arrangements, all beg for a separate panel discussion itself. So I thank you so much for, you know, all your time. Thank you to our speakers, Douglas Arner, Rocky Mui, Charles Dorsey, and as well as John Ho for an insightful conversation.